I will present the research paper mainly focusing about the audit fees. And there are many factors to affecting audit fees, and also previous researchers are studying the audit fee, which factors deciding the audit fee. And this paper is mainly focused on the banking industry. And usually the previous researcher is focusing on the manufacturing client audit fees, but this paper is more focusing on the banking industry. And nowadays, and also the audit regulation is implemented recently is the fair value measurement, which is more related to the banking industry.
That's the reason for doing banking, is because you have level 1, level 2, level 3 type of things.
So yeah, banking industry mainly they investing their money to the many various things and which demand to the fair value measurement. So, and fair value measurement demanding for a lot of work for as well as company, I mean the clients and also auditors. So this study is investigating those effects on the audit fee. And this is the outline. As I told before, there are many factors affecting audit fees, and the research shows that the audit fees are decided by client size or client risk or client complexity. But in this paper, focus more on financial industry, which is rare in the previous literature. And also interesting thing is this paper is also focusing on the industry exports. So if the auditors are expert in a certain industry, in this paper, banking industry, what's the effect on the audit fee? Is it increase or is it decrease? So both the scenario or the explanation is possible. So this paper investigating these things, and the final conclusion is the audit fee is increased when there is much the assets in the banking which demand the fair value measurement. And the paper explained this is because it is demanding much more work for the auditors. So more fair value assets increase more fair value, increase more fair value assets, increase audit fees. And industry expert auditors go both directions. Some of the industry experts lowering or reducing their audit fees, and the other kind of industry expert auditors increase their audit fees and differentiating, or I will talk later. So yeah, this is the final conclusion about relationship between audit fee and fair value measurement for the industry experts. And I will talk about prior literature and developing hypotheses. And Granted and others research or study about and showed that the fair value measurement is very difficult because of a lot of factors, and it demands various assumptions on the financial assets, or to demand the estimates, or to choosing various models to come up the final numbers or the measurement of the fair value assets. And also it demands not only the accounting knowledge, but also finance or economic knowledge, because it demands some of the expectation or forecast about future economic situations, and also it demands some of the finance models, like some simple things is discounted value and also CAPM or the other financial measurement to measure the derivatives or other assets. So it is various difficult factors to apply those fair value measurement. And one of the examples is to evaluate the non-traded security or equities. market, it is easy to measure or to figure it out how worth it is because we just see the price on the market. But when the banking invests some of the small company and it is not yet traded, how can we measure or evaluate those companies? And so one of the example, two of the example is one of the DCF method or the PER method. Do you know the discounted cash flow method? To measuring all the future the cash flow within the certain form and measuring, estimating all the possible cash flow incomes through the endless time and discounted for the appropriate interest rate, and that was the one of the method. And PER is price per earnings. So to measuring, you know, PER, the price of the shares divided by the price of the earning of the shares. So the ratio of the earnings and price. So that metrics are observable in the traded company or the stock. So if the company is, let's say, the company is manufacturing some parts of the automobiles. So there are other companies traded in the stock market who manufacturing the automobile parts. So we can calculate those companies' PERs. There might be some companies who manufacturing belong to same industries, and there will be the price and also the history earnings. So we can guess those same industry companies' PER values, and then the earnings of the specific companies, we can calculate those earnings and multiply those the other same industry PERs. So we can calculate the small companies which is not traded on the market. It is kind of those applying same industry characteristics to the specific unlisted companies.
So do you all remember what level 1, level 2, level 3 is? You're accounting students?
And
do you remember?
Level 1 is the simplest one, so it is traded on the stock exchange. So you can just see the end of the day price and apply the numbers to evaluate the asset. And level 2 is using the secondary measurement, like the correlation between the two markets, which is observable in the marketplace. So level 2 uses the secondary observations or numbers to evaluate the asset. And level 3 is like these things to estimate the future cash flow or to apply similar industry characteristics. And so level 3 is most difficult and much involved the judgmental decisions.
So we tried fair value, and the fact there was, let's say, our 90 and doing inflation accounting, and then the kind of thing died away. Sorry, that thing died away because the inflation rate from the U.S. went from 18% to 5, 3, 4%, and then in the last maybe 8 years, 7 years, became a big deal now. Trying to do fair value because people realize that investors are interested in current value, not on don't use the word current value. I hate the term like that. not only not current value. What FASB 33 and ASR 190 did was create the current value, replacement value new, replacement value used as base for valuation. Okay. The moment first the SEC issued ASR 190, and that was replacement value new, and then FASB issued the FASB 33, which was current value and price level adjusted value. And so that's one of those times whereby the SEC created accounting rules, which is very uncommon. Okay. Now, that kind of passed away. I think those rules were never really rescinded. I think they are still in the books, but they are not being used. And then there has been this expansion of usage of fair value, and a whole set of rules about fair value has come up, and is particularly important with current assets like banks and like titles. And then the titles basically are easy to value or difficult to value. And the level one are the easy to value. But you have to think that although they're easy to value, you take a balance sheet at the closing of the year date, and then you look at the value. You have to understand that there are a lot of oscillations at the end of the year because of profit-taking strategies, tax defense, and etc. And they really shouldn't do that. What they should do is some kind of real value averaging of the price. Now the level 3 ones are the ones that are the most difficult to value, and that's why the hypotheses here are related to if they're difficult to value, they're difficult to verify. Yeah, and so that's basically the discounted cash flow. What's the problem with discounted cash flow? That's one problem. That one, maybe they have projections. The worst problem is the discount rate. What are you going to use? You know, it's the same problem with pensions. You know, companies have totally unrealistic return on pensions that they use when they want to underestimate the value of their assets. When they want to overestimate the value of assets, they go the other way. And so they really should, the rules should force at least a comparable rate. Okay, or the rules should force, I'm not here to say what the rules are, or your historical ability to get return on your pension assets. That's what it should be. Correct? If you are making 4% on your assets every year, estimated that your return is 7 is ridiculous. Correct? You don't think you're going to change. Okay? You can argue that, well, I'm using a conservative ratio, or on my returns, I could get much higher if I was more risky, but that's not the point. So these are difficult rules. You think it's good to have fair value, or we should do it the old way? Hey, you're accounting students. You should be teaching me accounting. I'm a professor of systems. Go ahead.
I think as long as clearly disclose those assumptions or the conditions, we need to adopt fair value measurement. Instead of fair value measurement, the other option is just only the historical values, which is far from reality. But fully disclosing the basic assumptions or the models, it is important for the delivering what based upon those information, though that final number came out is very important to the information users. I think.
What do you think?
I agree with what Ben said. I think historical cost is definitely not used because accounting is supposed to reflect the economic substance of your transaction. I think fair value is a little bit closer on that spectrum, but
I developed this FASB 33 database for the FASB consultant that for 6 years. FASB 33, 36, 37, which was pension inflation accounting. And this discussion was live because at that time the FASB came up with the rules and the SEC had advanced it, and all the methods are adequate. But you're right, I tend to agree, is I think investors are benefited from having a bit more information. I like what Dan said, is you need to clearly state what the assumptions are. And by the way, the rules don't really require exactly. So what you really would like to have is a spreadsheet or whatever with assumptions very clearly stated. And Selena could go herself and recalculate her own assumptions. That's what it should be in this age of spreadsheets and Excel. But when it becomes really difficult, if these are kind of very sparsely traded commodities, securities of exotic companies, it becomes very, very difficult. I was on the board of the company, and they were closed-end fund for Credit Suisse, and they were doing this kind of buying these very unusual companies, and there's no way for us to establish the value of those things. In that case, what I always say is disclose as much as you can, but not as much as you want, much more than you want. Disclose as much as is possible that would be valuable for this company, and that's not being done. I'm moving again. If I sit there, I don't hear because of the noise. If I sit here, I have to look backwards. Go ahead, Ben.
And let's talk about the fair value account and relation to the audit risk. To make up those numbers, it is difficult for the preparer, the clients, but it is also difficult for the auditors. So if the fair value measurement increase the uncertainty, and increasing uncertainty means to increase the audit risk, because later on it turns out the auditors, the estimation or the measurement is proven wrong, and it causes the audit risk to the auditors. So those factors are imbibing to fair value measurement, so fair value measurement increase the audit risk. And also the Bratton and others finding out that to apply those fair value measurements, there are much more formal and informal guidance, but it is not absolute. So auditors just referring those guidance, but it is not the perfect one. So there are much more things to refer or to apply, but not
So Ben is saying auditors have no idea what they are doing.
And also Bratton says, even if the account, certified account encounters the deep unprepared or some lack of the skillful, not only for the staff but also for the partners. So auditors try to protect themselves. One thing is to increase the audit fees to maintaining the jobs level or the work is constant. So if they charge more, they can reserve the money to put aside, prepare for their litigation. So if they litigate, they use those surplus money to go it, or they increase more work to reduce or to make certain their audit result, and it causes the audit cost increase and reflecting to the audit fee. And also what makes matters worse is management use those situations. So to the applying the fair value measurement, the author not explicitly talk about these things, but imply that the management to deploy the fair value measurement to increase or to make favorable numbers for themselves. So it is difficult for auditors to detecting those biased value or biased assumptions to increase their assurance. So the first hypothesis is if the banking has more fair value assets, it increases more audit fees, and they uses the value, the proportion of the fair value asset compared to the total asset. And the second hypothesis is to go detailed. So the author tried to study those differences among those level 1 to 3. So level 3 is most difficult thing. So the first hypothesis is based on the fair value measurement is difficult for the auditors. So within the fair value measurement, the most difficult thing, which is level 3, increased more audit fees compared to the lower difficulty thing, which is level 1 and 2. So the hypothesis, second hypothesis is level 3 is more strongly connected to the audit fee compared to the level 1 asset or level 2 asset. Yes, and sometimes level 2 do the level 3 assurance, the audit firm hiring or to hiring the outside expertise, and which causes to increase the audit cost and audit fee. And the other factor is to considering the industry expertise. To industry expertise, it can go both directions to increase the audit fee and decrease the audit fee. The first one is to the story of the increased audit fees. The result of the assurance or the audit is to make a audit report and publish the audit report. But not only for that, but also the auditors make a recommendation to the companies or audit board to increase their internal control or to increase the company which might have some potential deficiency for the future. So those things might be different from the expertise audit firm to the expertise audit firm. We can expect that experts audit firm or specialized in the banking audit firm, they have high expectation to make more recommendation to the company during the process of auditing, and in those things, the banking expert auditors can claim that they can deliver higher quality of assurance, so they will charge more, but it is worthwhile. So the audit quality differentiation story means to higher audit fees, and for the manufacturing clients, there are previous literature that the specialty auditors charges more higher audit fees. And the interesting thing is, within the same audit firms, it is different from the office. So let's say the company contracts to KPMGs, but KPMG in the New York City and KPMG in the Wyoming. So the Wyoming more specialized to the agricultural auditing, and the New York City is more specified on the financial firm. So the audit fee is different even if to come to the same KPMGs depending on the region or office. So office level different, and also as well as the global audit firm means big four like the PwC or Ernst & Young and things. And shared efficiency is going the opposite way. So I think it is more focused on the express expressing audit just audit opinions. So if the audit firm specialized in the banking industry, they can give the clean opinion just putting the less amount of money, and so they are competitive to other audit firms and offering the low audit fees because they are specialized, so they can make a certain reach to the certain level of assurance by putting small cost or small efforts. So this is also supported from the previous literature to the manufacturing companies. I've seen that null hypothesis form usually in the statistical hypothesis, but in the accounting paper, he can use also null forms because it can be go both directions. So he just say no relations between the expertise and audit fees and finding out which direction they will go later. And the last hypothesis is combined all together. So first and second hypothesis finding out the audit relationship between audit fee and fair value asset. And the last hypothesis is combined together. So between those relationships and then also investigating the combined the banking expertise into those relationships. This is data and model, and they use the banking firms and some of the consecutive years. And the first hypothesis is focusing on the audit fees and fair value amount divided by their total asset. And they put also the other control variables which is proved to the previous literature. So the sign of this coefficient is main focus on the first hypothesis. And the second hypothesis is divided into this fair value assets into three subcategories. So fair value 1 asset divided by total asset, and fair value level 2 and level 3, and to compare these delta 1, 2, 3, and we also expect that delta 3 is highest one because it is the most difficult. So highest one expect the audit fee more strong.
The relationship is reversed. I mean, the audit phase affects the fair value instead of fair value affects the audit phase. Suppose sometimes for audit phase is big because this firm is a big firm, so the audit phase is high. So a big firm with more fair value today.
Oh yeah, that's possible. Yeah, so let's talk to it later. Yeah. There is also control area of total asset is included. So in this control value, the total asset also included. So to the effect of the total asset is converted to the coefficient to be in front of the total asset value.
Your point is it controls the total assets, so
Yeah.
it controls the size.
Yeah.
Yes, yeah.
This is the previous literature's findings. So big four firms affect to the audit fees, and if the company is realizing net losses, it affects the audit fees. And also this is the standard deviation of the returns. So you can assume that the returns volatility means some of the risk of the companies, because if the return is very highly volatile, it means the company is some of engaging in high risky area of operations.
I actually okay, why does the control variable 0, 1 loss? Why don't they just use the value of the income as a control variable? It's just kind of a little bit strange doing it that way. But I see it many places. Because, there are many companies that will not want to declare, maybe there is a bonus thing on the contracts, etc. They don't want to declare a loss. So what do? They declare $2 gain. Okay, and I exaggerate $2 gain, but there is a lot of leeway in accounting rules. The way that you can, that's called manipulate, but you can change the value of your net profit by kind of taking certain options. And so the incentive in many of these contracts creates this kind of change. I mean, in the old days, you guys were not born, people cheated in their financial reports, basically to pay less taxes. And now it's exactly the opposite. They don't care paying a lot of taxes as far as, in most of the cases, as far as the results look good for their own bonuses and etc. It has changed the directionality. And a lot of the tests were one-tailed tests. And the one-tailed test kind of looks at directionality of a particular assumption. And at this moment, its kind of directionality is different from the old auditing test.
And also it is the banking firms, so those control variables are relating to some financial characteristics. So the commercial or agricultural loans or non-performing loans are like a delinquency loans or some of the doubtful for recollecting things. And those things are interest rate sensitive liability and assets. And the third hypothesis is relating to the industry expertise. So they use also dummy variables for the expertise. So it studies for the relationship between the Audit and expertise. And the second thing is to find out those combined relationships. So the pi 3 is the main focus. So the effect of interaction between the expertise and fair value assets. And also last one is divided into the 3 subcategories and interaction with the expertise and fair value measurement assets. And this is descriptive statistics. And so there is the total assets also included on the control variables. And usually these statistics talk about the fair value. Second level fair value option is the largest one, and the third level 3 is a little bit smaller compared to the other thing. And 19% of the total asset is converted or applied to the fair value asset. The first model is without those concerned variable, and the model 2 and 3 is our main focus. And the coefficient of the total fair value positions compared to the level 1 and 2. So level 3, if 1% of the increase of the level 3, it has more largely on the finance, on the audit fees, and this is insignificant.
So what do you guys think of this? And then we do go back one slide. Up there. It always bothers me, studies like this, how many control variables they put in there. What would you do in this case if you want to do the results? You would try 100 control variables and see the ones that get you the better results. Yeah. And it always bothers me when there is too many. Wouldn't you do that? You wouldn't do that. You won't do that either.
What you just have to work on, you have to understand why you have to do it. Not just it's okay, so
Blocks, it's like 0, 1 for loss. Okay, I really crap blocks, excuse the expression. Okay, you need to control that's kind of modern economic type of theory, etc. But when you start going down on the lane of controls, you get this clear feeling that they tried a lot of variables and they kept the ones that they put a little bit ahead. Also, go to the next one. Very significant results. But the first label wasn't something that were terribly interesting, correct?
And also we can increase the total asset or big flow form and more volatile returns affect to increase the work. And also I think this is added by the editors. I mean, by the editors' comment. They have put a lot of control variables, but I think editors concerned that there might be some other omitted variables. So also try to input those variables, not just the fixed level, but the changes between 2 years. So if we focus on the differences, the omitted variables might be eliminated because we subtract one value from the previous one, so those might be possible effects eliminated, and we also put those change variables into the same model, and it affects if the fair value measurement increased to between 2 years, at the same form, it also same direction effect. There are many possible ways to determine which audit firm is expertise and which is not expertise in the banking businesses. So one method is invented by Ben, or different Ben. And have you heard the Hofstadter index in the econometrics, which is decided how the market is concentrated on the companies, like
Concentration, industry concentration.
yeah.
With their market.
It's simply adding the market shares by square through. If one market is divided by evenly 10 companies with 10 shares, if some of the market share, so yeah, it goes like this. And this one is so apply those things twice, it increases those concentration effect. Because this one is much more higher than the first one. So I think when borrowing this concept to deciding those things, so if one audit comes to some of the squares which is dealing with the banking businesses divided by some of the total assets of all companies. And the other way is the Francis method, and the paper didn't exactly report how they decided which form is leading form, but they decided it anyway. So if and only if the firm is specialized in the financial sector, in the firm basis, and also as well as the office basis. So they applied those two methods to decide the industry expertise, and the result is different. The opposite ways. So Ben's method to affect the reducing effect on the audit fees, and the Francis method increase the audit fees. And the paper says interpreted this result because Ben's method including non-big four companies, which is they didn't name those specific audit firms, but there is the non-big four audit firms which is specialized in the banking industry. So those small firms, but specialized in the banking industry, they offer some low audit fees to the bankers. So they contract those audit fees, and so this method to decide the industry expertise to effect or result in the reducing audit fees. And the Francis method is decided by or belong to audit only those big four companies, and big four audit firms to save themselves and differentiate the small companies, and we might think they can advertise themselves with the higher audit assurance services, not only for the pre-opening but also other increase of the internal controls and other things. And the differentiated audit result converted or resulted in the charging more audit fees. Yeah, so it means
Although it's still negative, when you come to the big one or the big part, not the big one,
no.
it's still negative.
Among let's say the big four, if the auditor is big four, it increase the audit fees like this, the efficiency, and removing those effects. If it is the banking specialized big four, it added additional audit fees to the clients.
I mean, for the second translation, it's only before, right?
Yeah,
Yeah.
yeah, this one.
So for the bottom three, when you come
Oh, this one.
and you put the two together, and then when you control it,
Not only big fours are converted into the Francis method. Among the big four, the office also specialized in the financial sector. So within the big four, some of the specialized and the other offices are not specialized.
I always find it very interesting when they talk about specialization by firm or by office. And there must be an effect in both ways. But I find it very interesting because it's very difficult to pull it aside.
They didn't told how how they decided which office is specialized.
Yeah, that's right. I kind of think about first there is a problem to begin with defining industries. Okay, the SIC codes and etc. Are really not very good, and very often researchers kind of define their own industry. Then all these companies have consolidated financial statements, and very often the sectors of the financial statement are very different. And then you talk about specialization, is by office and by city. And could be very, if the company is a national firm, what does it mean to be by city? Even if the firm is based in Cleveland, maybe the largest sales are in Manhattan or in New York City or in California. So it's tricky. And then the results are strong, you start finding it very fishy.
And also to find out the interaction between the fair value measurement and the industry expertise. And those best criteria, if the specialized audit firm offering the reduced audit fees, even if they offering the reduced audit fee, if the fair value market increased in those audit clients, they charges more to the client. So these findings are a little bit interesting. Yeah, they offer reduced audit fees, but if those clients have more fair value measurement, they charge more. And for the practice results, those things are statistically insignificant, so we cannot tell there is a relationship or not. So main finding is if the fair value asset is increased, the audit fee is also increased, and positive relationship. And if the expertise in the financial industry, including the non-big audit fee, they offer some reduced audit fees to using their expertise and reducing the audit cost. But within the only big four firms, they advertise themselves differentiate with the small firms and they charge more. And if it is non-big four firms, if there are more fair value measurements, they charge more. So I think not only the fair value measurements, but also we can generalize these equations. So if the audit difficulties increase, it might mean the increase of audit risk, and increase audit risk, increase audit cost to reach a certain level of assurance, and it means audit fee increase. Might. Thank you. Questions?
So what do you think of this? Mike Etheridge is a very good researcher. Okay, it's like Francis and Etheridge are very, very solid. Okay, but what do you think of this? And let's apply a little bit of professional skepticism. They didn't consider what? Originally. Jenny, what would you say?
There may be some issues like what you were
Speak a
saying.
bit louder.
I said, even if there are some issues kind of with what you were saying with the variable selection, especially with the excessive number of controls, the findings seem pretty intuitive to me regardless. I mean, I would expect that if there was more audit risk, or, I mean, maybe it doesn't necessarily create audit risk by having these fair value measurements, but if it's more work, then they're going to charge more money. The part that I was kind of surprised about was including non-Big Fours. There are lower audit fees if they are banking expertise. I would have thought that no matter what, whether it was Big Four or otherwise, banking expertise would lend to higher audit fees.
What did you think?
I think I have some doubt on the competition of audit selections. In Korea, in old days, the government designated auditors to the specific companies. So it might be increased, a lot of increase of audit independency, but the lack of the competition between the audit firms. So I think reducing the audit fees have always a potential risk for the lack of the qualities or the audit opinions, shoppers, things like that. So, even if they meet the basic assumption or basic qualities, the decrease is the just market the mechanism. But there is a big assumption that decreased audit fee also or still reach to the certain level of assurance. But in my country, the being a CPA is not that fancy because the audit fee is dramatically decreased, so the salary of the CPA is not that high compared to the other financial jobs.
Can't do anything else to become an auditor. I just think maybe Andrea, who was in corporate also, should answer this question. What is I just have difficulty thinking that audit fees are not mainly determined by competition. And I also have difficulty, I think it has been established in the literature that Big Four charge more than smaller firms. And I see Marina, my wife, in several universities, a couple of times she changed auditors. Okay, and I don't think she was opinion shop. It was all about saving money, paying less.
I agree. I think the audit fees have a lot to do with competition because, well, from my short experience, a lot of the partners, we had a realistic budget that we provided to them, but they always said, okay, cut it by 25%. And then the client would negotiate for even lower audit fees, even though the client was a high risk client. So I think competition is a big part of it.
Go ahead.
So the theory would be that fees would be negotiated based on competition, and whether or not to take the audit in the first place would be based on the risk of the audit.
I don't have a theory, but something like that. The other thing is, this is like, does the dog move the tail or the tail move the dog? And audit fees are not that big on the budget in general, but they are big on the controller's budget, if that's the way to bring it out. And the other thing is when committees became more independent, audit committees, things change a little bit in relationship because really came out of the audit committee, not of the budget of the controller or something like that. That changed a little bit. But I just kind of see these studies. First, Mike Edwards does really competent work. He's very able, I see, because Vasarhelyi is in Kansas, and Alex and me have been working with Raj for over 20 years. We run into Mike every year in Raj's conference. And he comes and we talk to Mike and etc. So I am sure that his work is well done. We are not doubting it. It's just the business sense of some of the discussion. The other thing is, I don't know what they are now, but in times that I was privy to this, the firm was charging something like 4.8 times the direct salary of their staff working per hour. Okay, so if you are paying $20 per hour for Andrea, they were charging close to $100 for Andrea's staff. And this changed, but not that dramatic. Also, auditing, it used to be very hours oriented. You know, when my wife started auditing, it was all manual. Okay, so, and I remember her in one of the, she was with a small firm, I won't say the name because we're being paid here, and she would do the audit work, finish, and the budget was higher than that. So the guy said, just go and analyze some accounts for the rest of the time. Okay, but the billing was 5 times direct salary, without fringes, etc., or 4.8 times. And so the variable cost here, not very much there. Okay, and so what happens if you have to have industry expertise? Your base doesn't go up so much, hiring someone that costs a little bit more. Yes, I have difficulty thinking that audit fees will be very sensitive to expertise. But I could be wrong. But maybe in the competition sense, this firm is expert, this is not, that would affect things. Certainly my wife complained bitterly about inexpertise of audit. I teach these guys everything they know all the time. So anyway, I just think that in general, in audit research, we give more importance to auditing than auditing deserves. Do you understand what I'm saying? That we are thinking, I think my observation is audit is basically, audit either is driven by prestige, large firms have to have large auditors, and the other thing is there is a reputation penalty on a firm, on a company, if they keep changing auditors. Okay, and besides that, it's all about fees.
This paper I'm going to present is on audit partner location and financial reporting quality by the Sharma and Kenny in 2014, so it's a relatively actual very new paper. So the research question is here is how did audit partner location affect financial reporting quality and if it actually does actually. Why this question is important? So why should we have audit partner location? Because it maintains objectivity for auditors, and then also arm's length relationship.
To avoid long-term sexual relationship with the partners and clients. I'm just joking, but E and Y has been censored this year for 2 events or something like that. Did you hear about that?
Also, it's encouraged complacency, so it encourages auditors to exercise professional judgment because, you know, if they have a relationship of 5 years or longer, then they might get used to doing things a certain way and not want to change the way they do things. Why shouldn't we have audit partner rotation? Well, a lot of them have argued, a lot of industry experts have argued that they actually lead to lower audit quality because you have to start over with a new every year, so they're going to have to. And then the other reason is it imposes our economic and social costs. Examples of that is that management might take advantage of the auditor's lack of knowledge in their first year on a new client, and then try to do earnings management or that kind of stuff. And also, it might result in a bidding war because if all the audit firms know that you have to change clients after 5 years, then after the 5 years, they would be fighting to get the lowest. Yes, question?
Oh yeah, I just was under the impression that two of these was kind of mitigated because I thought that maybe you were the one explaining this to us earlier. I thought that when they are getting ready to change the audit partner, they bring a new audit partner in for the year before, like learn the audit that's going to be the new partner for the coming year. Is that not the case?
Well, you know, there are two things here. I don't know if we're talking. One is firm rotation.
Yeah.
Okay, firm rotation is when you're required to change your audit. The other thing is the person who is running the engagement, which now has been a while. Typically, there are two partners there, one the junior, one the senior. After 3 years, I think that's the number. The junior becomes the senior, and the senior rotates out of the game. Is that correct?
I'm not sure.
Something like that, or 5 and 7. Can't remember exactly. But that's the way it typically works in big engagement. I'm not sure if it's small engagement, they train the young partner.
No, I didn't.
It doesn't have to be the young partner, it's a junior in that engagement.
Oh yeah, I think it's usually, now that I think of it, usually it's the junior partner, and then they probably shadow like the actual partner for like 1 year or 2, and then they're brought on. But still, I mean, like, because the firm might, so the auditee firm, the firm that's getting audited might like this partner that's in a lot. But the new partner, even though he brings them in, they might not like that person that much, right? So when it comes 5 years or so my counter argument is it could still be like, okay, we want to shop for a new like audit firm altogether. Because actually this part of this research we'll talk about, so how they structure their study is around, so they actually, their sample is firms that change, so firms that got audited that changed their audit firms altogether, not just their partners. That's also part of their study. So yeah, it was a big work on myself, trying to lowball prices.
Is a bidding war a bad thing or a good thing?
Depends on if you're the auditor or the firm getting audited.
Absolutely right. Don't laugh about it. That's exactly true.
And so other reasons why it's important is it's very important from a regulatory point of view. So regulatory bodies are very concerned with auditor rotation, whether it's at like the auditor firm level or it's just at the auditor partner level. I was interested, so I looked up this report. So different countries have different regulations regarding mandatory audit firm or partner rotation. So audit partner rotation in these countries, Australia, Canada, China, Germany, Taiwan, is mandatory. And then it's mandatory for select groups. Usually that means like financial institutions or listed companies, that kind of thing, for firms in the UK and France. And audit firm rotation is not, I don't think there are like, I mean, the countries that are most similar to ours in terms are most similar to the US in terms of their legal environment, like let's say Canada, UK, I guess France, and all those kind of countries in Australia. They actually, so none of them have audit firm rotation either. So the, like on the spectrum, the highest they'll go usually within these countries that have a similar system to us is audit partner rotation, which is, I think it's interesting somewhat because there was a debate in the US about whether they should have audit firm rotation. And then like even more, I guess, extreme in a certain way than audit partner rotation. But there's really like no country that we could look to for hints about what that would look like because audit firm rotation is barely ever mandated
they now have president rotation. In Brazil, they are now talking about impeaching the replacement president.
Wow.
Because he was the vice president and they found electoral illegal financing with the president and the vice president. And now the big contention, the Supreme Court of Brazil, if you take them together or take them separate. It's a big mess. I think very bad for Brazil if they replace presidents again in a month or a few months.
So that ties into this current slide, the prior literature ties into what I mentioned before in the slide before, that there hasn't really been a lot of research, and if the US regulators want to do something like audit firm rotation, or actually they only implemented audit partner rotation in 2003, which is why this study only came out around now, because they took advantage of that. But yeah, so there's very limited research in the US because audit partner data is not public, and there's very limited research in audit firm rotation because like we don't have, there aren't very good examples we can go to for women.
And you know, I am not 100% sure, but 95% sure, starting this year, that the audit partner names, they will be somewhere that you can pick up the data. Okay, so everyone is excited about a new line of research. Every time new piece of data, when audit fees came out, oh, it was big excitement. Just imagine if the US adopts the CAM, and the CAM is not a standardized thing, how interesting that would be for research. CAM is critical audit matters, and we have been looking at that. We'll be looking at it tomorrow, right? Yeah. And basically, I think UK and Holland already required, which is basically, instead of the standardized report, we are supposed to discuss critical audit methods in your examination. I think it's a great step. In the US, they tried to do that a while ago, and they were rebuffed, and they are trying it again. I actually don't know where that project is. I'm going to ask them when I'm there, find out. I didn't want to ask today. I was talking to the Deputy Auditor General, and I wanted to ask, but I didn't have the courage, so I didn't ask.
The last thing I saw about that was, I think last year, there was a bulletin, a PCOB bulletin.
They have a exposure document, don't they?
They may, I saw like
Yeah, I
a
think
short
so.
notice.
I think they reworded, they changed a little bit based on comments. Because when Denise, me, and Alex were working on that paper, we looked at that. I think that's what it is. Actually, I'm very curious about it. We should find that out.
I was going to say, the partner thing, this is going to be something new for the US, but I think it's already done in Australia.
The naming the partner.
Yeah.
Yeah.
Yeah, so if you're looking for research ideas, you can go Google Scholar for Australian papers.
You see, it's like audit fees. Audit fees were municipalities in North Carolina were required to disclose audit fees, and Australia. So a lot of the papers were focusing, and that's what Selena was saying here, that you go to the research in a different country where the data is available. Remember, we follow data. Until we have data, until there is data, we don't do research, right? Not like the old days that we had all these theories. I just got the paper submitted to JAPA, and it's a sociological view, I think, of auditing, but I'm not sure. I don't remember. I just saw it. And there are 33, the paper is only hypotheses, 33 hypotheses. I kind of liked it. I like the idea of something going back to the days that were a little bit more intellectual, as opposed to just beat data out.
Yeah, so like Andrea said, I guess that's the reason probably that the
What does it mean negative association between audit time allocation and discussion accruals? What does that mean?
It means if you have audit partner rotation, they probably did a 0-1 thing as well. There's a discretionary accruals goes down.
And that's good or bad? Discussion accrual.
Okay.
Are discussion accruals a good thing or a bad thing?
Usually,
Only the non-discretionary accruals from the
What is normal? Of course, normal.
it's not bad.
But bad or good?
I can't say it's good, but it's not bad.
So if we don't know if it's good or bad, what's the finding?
There's a assumption of
Just a fact. That doesn't mean anything.
it must have something.
It's not only Jones model, there are plenty other modified Jones models and etc.
Yeah, but for Jones model, one factor is related. You are focused on non-discretionary.
Non-discussion.
Undiscretionary.
Discussion.
So if there's a
What is the discussion of your group?
it's bad.
You are the corporate. What is the discussion of your group?
It's an accrual that management makes up. But anything.
It's an accrual that managers make without, that they could not make. It's discussion.
Right.
But it's a little bit unclear if they could not make, because there are things in operation you have to approve.
Well, I know for us, we had a huge balance in miscellaneous. So I guess that for this company, that would be one of their discretionary accruals. And we always had to have a really good explanation for like the millions of dollars that they accrued and the expenses in that account. They always, but anything that was random went into that account.
Okay, it's a proxy for my company. So it's bad. If
There are a lot of accruals. What does it mean? Some of those might be fake accruals, manually generated. Okay, so it's bad. Right? Too many of them.
One aspect of earnings quality. So sorry, I said it wrong. Should be the opposite. So like then they said I think the first research here is advocating mandatory audit partner rotation because they're saying negative association. If you have partner rotation, then you have less discretionary tools, right? And then if we're assuming earnings quality means higher earnings quality means less discretionary tools. Then you want mandatory partner rotation. That's the research from Australia. And then the second one is longer audit partner tenure leads to lower propensity to issue modified going concern opinions and higher propensity for clients to just meet or pay journey. So
So
again,
it means you have a partner for a long time, is less likely that he'll issue a going concern opinion. So why is that? Huh? Corrupt. Yeah. Well, that's an extreme word, but you become very cozy with the firm. They are your friends, you don't want to upset them. The relationship is less antagonistic.
but we don't know that. They might just be, they might know the business better and then are more accurate in predicting.
And be more helpful, and this whole idea that the CPA, the partners, the CPA firms don't do consulting, I thought was a great idea when they came out with it. And before that, I saw on and on and on. So WorldCom and etc. etc. In retrospect, unintended consequences are not very good. Might be a bad idea. You might want more consulting by the CPA firm, helping business to become better. Maybe other kind of balance, checks and balances against corruption in the particular thing might be better.
Do you have a question?
yeah. On the point about how the audit partners who
relatively the accuracy of these sort of opinions, depending on like how long they've been in a relationship with the firm?
There is plenty of literature on auditor rotation. This is just one. Now, determining a particular pattern, how long you have been engaged in the US is not possible because you don't have public data on who is signed the lawyer. It's not signed Joe Blow. It's not signed Ben Newman. Okay? And what I was just saying before is that next year, I think we're going to have data for this year of who was the auditor. I saw this conference. I haven't followed up. Maybe we should find that out, Andrea, if that's really true.
No, it is. I think they became effective January 1st of this year.
Wait, so if that's the case, then how do we know that? Go back to the previous slide. How do we know that longer audit partner tenure leads to lower propensity to issue modified billing certificates?
Because there are some countries that you have that. Well, right?
Oh, yeah.
So if we get that data that I mentioned earlier from those countries right now,
No, that's what the data they're using. That's the kind of data.
the data that she's referring to is just deals with whether or not they're issuing modified billing concern opinions or not. I'm wondering like the accuracy of that because like basically like there's two factors, right? Either they're cozying up to the firms and they just don't want to rock the boat by issuing a going concern opinion, or they're actually getting better at evaluating the firms. And as we've seen in one of the previous papers, many going concern opinions turn out to be wrong. So perhaps they're just better at deciding whether or not this company is actually going to have a going concern.
But it's hard to test that because if the firms are actually trying to, like they're doing something shady with their relationships with their partners, they're probably not going to tell you.
Well, yeah.
Right?
So I mean, like, I
it's
guess
hard for us
it'd be easier to see, like, oh, like, when these people are wrong, or when they're right, like, just take into account, like, the amount of years that they've been working with that firm, and, like, compare that. So, like, if, like, let's say, we take all the auditors who work only 1 year with the firm, and they have, like, a 50% accuracy rate, which is really low. So let's just say, right? And then compare that to an auditor who's been working with a firm for 5 years, and then they have a 90% accuracy rate, then wouldn't it be possible for us to say, the evidence suggests that working with the firm longer means that they're more accurate rather than like more corrupt.
Maybe the word corrupt make it
Maybe
strong.
not corrupt.
But I think your point is well taken. There is a trade-off of how well you know the firm, meaning that would be good for your audit, right? Knowing well the firm and the business. They always say that. And the other part is how intimate we are with their management. I'm not being for decisions here. So you build relationship makes your professional skepticism go down. That is a trade.
Yeah, there's a lot of literature in that area because I think you're referring to audit tenure, right? How long the auditor has been with the client and whether that has an impact on audit quality.
Yeah.
Right. Yeah, so there's a huge area in the literature.
But has been audit tenure in general, meaning how long, when you change audit firms, there hasn't been a lot of literature about partner rotations.
Right.
Or partner rotation includes changing auditors because you rotate on.
Yeah, so the studies in Taiwan actually go counter to what we saw in Australia. So the author inverse relationship between partner tenure and the level of absolute discretionary accruals. So here there is research in Taiwan about how if your partner tenure is longer, you actually get a little bit. Well, I mean they're assuming because it says inverse relationship, so that means your
mean, the fraud is won't count. They were basically accruals.
And then there's also some other studies found a weak association between partner location and lower financial reporting quality. So only weak association, but they still show that if you have partner location, then your financial reporting quality might actually be better. There's also been some research in the U.S. regarding like this area of research. Measured in Johnstone in 2010, their research said planned engagement effort increases following partner rotation, but not clear whether it's an audit partner effect or audit firm effect. So the study here that I'm going to present later on actually tries to distinguish between an audit partner effect and an audit firm effect. Also, Doherty et al. In 2012, they surveyed partners and they believe, so the partners believe that the other instruments will likely improve, but trade-off would be lower audit quality and higher economic and social costs. So the partners don't like that, this mandatory rotation. So the H1 here is there is no association between audit partner rotation and quality of audit clients' financial reporting. And I personally really like their research design. So they said, the authors said there's this new mandatory partner 5-year rotation regulation that was passed May 6, 2003. So they actually used firms, they found firms who changed audit firms, like they changed their audit firms altogether between the period 2000 to 2004. Why they did that, their rationale was that once they changed their auditor firm, then it's like they're starting on a clean slate, and that they can know, because I think when they change their audit firm, oh yeah, of course, it's going to say in their audit report that they actually changed their audit firm because the signature will be from a different firm, and then they can tell 5 years later that they have to change auditors because regulation passed. So now all of the firms that changed during that period, changed audit firms during that period, now have to change their audit partners. Yeah.
Doesn't that assume though that the audit partners aren't changing on a less than 5-year rotation? For example, if an audit partner gets fired or leaves or something like that.
Yeah, exactly. I think before, so I think when they came up with the research design, they mentioned in the paper that they probably already had some information that most partners don't change. Like most partners do not leave the engagement before 5 years is up. They also did a preliminary survey, my next one here, which showed that most firms were in compliance, so that they did change after 5 years, but they only changed after 5 years.
I mean, this is data that I'm surprised no one really collected. Meaning firms, companies will tell you who the auditor is, but it's not a secret who is the partner. They are not revealing any secret. So I wonder why someone didn't just send letters to 1,000 companies and say, who was your auditor, and did some study. Something you guys can do, but it's not as comfortable as open compass, right? Messy.
So that was their research design, and how they go about it is, of course, regression. So there is this indicator variable called meeting or beating earnings forecast with adjustments. There. So if one is a discretionary accruals allow meeting or beating the earnings forecast, the discretionary accruals are estimated using cross-sectional modified Jones model, portfolio performance adjusted method developed by Kotari et al. In 2005. And basically, so, oh right, so my concerns with this is we learned in like our accounting classes that there are so many measures of accruals quality, and then they just use one. So I was going to mention in my last slide, one of my concerns is they didn't use models like the childhood shadow or whatever. They did sensitivity analysis. They changed their discretionary accruals, how to measure discretionary accruals, but they still use some version of the Jones model. So because there are so many different versions.
So what did you learn that Jones model is not good?
Well, Jones model is only one, and it's also, Jump Auto, I think, was developed in 1995 or something like that. Well, I mean, this is an adjusted version, so they did add some things to it.
Looks like a Cadillac. You were the best.
I think so.
Yeah, because the new Cadillac will have guidance systems and better brakes and cameras and whatever. So, same thing in research. More recent research, use old research, and improve the methods.
Yeah.
Although sometimes it's good up.
Because I think we read a paper that compared like all of the methods up until I think the paper was relatively new, so maybe up until around 2010 or so. And then I think the challenge that usually do better at predicting.
I would love to do something if you can get the method.
So basically they use discretionary accruals above or below industry to signal earnings quality. So I think Professor Miklos mentioned this before, like having discretionary accruals above or below your earnings forecast doesn't necessarily mean you're trying to manipulate that, right? So that was another concern of mine. It might just be, maybe, even though it's discretionary, maybe the firm thought it was necessary and the auditor agreed that was necessary in that year to make that discretionary. And it might not be for reasons of like trying to make the earnings forecast. And also, another concern is that this is only one signal of earnings quality. There's so many that we went through. I'll go through some, I think, in my last slide as well. I don't think this captures. I mean, I guess it is a measure for earnings quality, and I think they mentioned in the paper that it has been used a lot in the like audit quality literature to see like this meeting of the earnings forecast. But I also think maybe they could try some sensitivity analysis with other measures of earnings quality. Oh, they did one. I think they did going concern opinion, but this is going concern opinion. I think is more like an audit quality kind of measure. Since they actually mentioned in, I think the title is about reporting quality, and I would also like to see other accounting measures of sensitivity analysis. I think that would happen. So they compared last 2 years of outgoing partner to the first 2 years of the incoming partner, and their hypothesis is to test whether, well, they think that, well, actually they don't make any directional calculations, but they want to compare like if the prior auditor did better than the new auditor, like the last 2 years.
Did better means lower discretionary.
Yes, it's only lower. Only using discretionary quotes actually to tweak or beat earnings forecast. So these are their descriptive statistics. What drew my attention was that if we look at, so this means if they had foreign operations, I think it was a 0.1 indicator variable, so 0.87 means pretty high. A lot of them had foreign operations. Big four, that's another indicator variable. So 1 if they had a big four auditor and 0 otherwise, that's 0.61, that's still relatively high, so more than half of them, or more than half of them had a big four auditor. And also analyst falling, that last one is analyst falling. Sorry, so I think maybe we should look at, so the mean there, and then you can look at the median for analyst falling, that's 7 analysts. I think that's quite big. Because, well, I mean, they use CompStat for instance data, so that would be, it would make sense. And then because auditor partner rotation is only mandatory for public firms, it would also make sense that they were the largest firms. But 7 analysts is quite a bit because I think
Is that number of analysts that follow the company?
yeah, I think so.
Awfully high.
Let me just, because I put the last slide.
Yeah, it's a number of analysts.
Yeah, exactly.
Sometimes I remember seeing a paper, the large majority of companies had only 1 or 2 analysts that follow. That's not my area, but
That's what I thought too. Like,
sounds awfully high.
I didn't want to just pull a number.
Really for big firms, local, on average, not more small firms, one firm.
And so it means that the number is so high, but you see, look at, can you go back to the table?
Yes.
Yeah, the mean is 9 something. And the maximum must be 50 then, to make this mean become so high. They don't have maximum.
They might have 75% is 30.
What is it?
And even Q1,
35.
even Q1 is 4.
So I guess some of the local big firms.
Yeah, very good for job. So that was one thing that surprised me a bit as well. And firms.
Oh, yeah.
And then,
And what is the control variable for it that you highlighted as?
sorry?
What is the control variable for it? For it, yeah. What does
Oh,
it do?
for means if they had, it's a 0-1 indicator again if they had foreign operations.
Most companies do, don't they? Little bit.
If they're in coffee stats, probably, because of the firm. It's almost 90%. Right, so they ran some, the authors ran the t-test for, and the Wilcoxon test for their p-values, and then it showed there was a significant difference between, so P4 and P5 means final 2 years with the outgoing partner prior to partner rotation, and P1 and P2 were 2 years with the new partner following partner rotation. So the p-values here is basically a test of the differences between P4 and P5, so the former partner versus the new partner, and then these p-values are quite high, so good for the t-test is 0.01, and then for the Wilcoxon probably be a better test. So highly significant. Here are the actual tests. So I just move this so we can see. So the authors did the test with the full sample. I didn't add that table here because I think I show it here. So the full sample shows significant positive relationship between partner rotation and leading or reading and analyst forecast using discretionary tools, which kind of shows that the test shows that how it relates to their hypothesis is that if you had partner rotation, then your earnings quality actually goes down because mandatory partner rotation, then your earnings quality goes down because they said you have partner rotation is a 0-1 indicator variable, then your meeting or beating earnings using discretionary tools goes up that coefficient, which means, and we don't want them to be meeting or beating analyst forecast using discretionary tools because the assumption is that having discretionary tools is a signal of lower reporting quality. Is that okay?
Yeah.
Okay. So the authors also wanted to see that if it's different for having a big four auditor or having, like, if their audit firm is actually a big four auditor or if they're auditing large clients as opposed to smaller clients. audit quality might be more effective. So we see in these tables that it's highly significant for non-Big Four auditor, and with both large clients and small clients, which shows that. So I guess the most significant we would expect is, yes, the non-Big Four auditor and large clients, because non-Big Four auditor, you don't have as many resources, and again, large clients, you need more resources. So audit quality goes down, and definitely that is the highest statistics we see here. And it's interesting that if you had a Big Four auditor and small client, that coefficient isn't really significant at all, which means if you had enough resources and you faced a small client, which means you didn't need as many resources, then having mandatory partner rotation does not really affect your audit quality. And the authors also wanted to test if this effect persists, like if it's only for the first year, we're assuming the audit partner is actually just getting used to the new audit partner is getting used to this client, whereas if the effect persists as they get a little bit more familiar with the client, the new audit partner. So they see that the effect diminishes substantially, but only not for the non-Big Four auditor and large clients. And again, that shows that if the audit firm itself does not have that many resources to train the new audit partner adequately, and also if your large clients demand more time and effort of your audit, then your audit quality will be negatively impacted if you have mandatory audit partner rotation. And again, we see this test on if you're a specialist industry or not, or if you have a large audit office, a large audit presence in that city or not. So we see that the industry, non-industry specialist, that coefficient is still highly significant, and also the small audit office.
The N star is the sample size, correct? The N.
N number is, yeah. So the hypothesis is if you're not a specialist, then you might not be as familiar with the audit client, and then so when you have mandatory partner rotation, your audit quality might be more negatively affected than if you were an industry specialist. And then same thing, if you had a small audit office, then you might not have as many resources at your disposal to train and familiarize your new audit partner after the mandatory rotation, which is why the coefficient is more significant than if you had a large audit office. So overall, the conclusion is the effects of partner rotation are more acute for auditees with more complex operations, so the larger firms, and auditors with less resources at their disposal, so the small auditors and non-industry specialists. And they also did some additional analyses on audit firm rotation as opposed to audit partner rotation. Because remember how they did their sample? They selected firms who had, in their first 5-year period, changed their audit firm. So they had a new auditor altogether. And then in the second 5-year period, they kept the same firm, but changed their audit firm. So they could do a test of the differences here. And then they found that when partner rotation, so audit firm rotation is more costly than audit firm rotation. However, I would like to bring up the point that partner rotation is mandatory, whereas firm rotation is voluntary. Like during the period that they did their study, so there might be other variables in effect that they didn't capture that would result in the firm being audited change their audit firm altogether, as opposed to changing auditors changing audit partners because they cannot control changing audit partners, but they can control changing their audit firms. They also did some additional tests issuance of a going concern modified opinion, which is another different measure of audit quality and reporting quality as opposed to the meeting or meeting earnings forecast using discretionary tools. And then they found a negative relationship between partner location and issuance of a going concern modified opinion. But as we mentioned last week, going concern opinions are often inaccurate, so and then, so my conclusions are, I think I forgot to add that slide, but my conclusion is, I'm not so sure about like the meeting or meeting earnings forecast using discretionary accrual, that dependent variable that they use, but I definitely really like how they structured their study around that time period and then having first firms that actually changed, that changed their audit, like firms getting audited changed their audit firm, and then use that to measure actually a thing that was not measurable at the current time because partner names are not included in their audit reports, and then try to get around that difficulty. I thought that was very interesting. Some future directions I would suggest is the effect that they measured, is it really a partner effect or an audit team effect? Because even though they change audit partners, but sometimes the audit partners themselves bring a whole different team. Like they choose their team that goes into the audit with them. I'm not sure if that's true from your experience.
Can you repeat the question? I was looking at the spreadsheet.
But yeah, so I heard from my friends who work in audit that sometimes the audit partner brings their whole team into a new engagement. Like even though they changed their audit, so now we have this mandatory audit partner rotation. But like the first audit partner, the outgoing one, might have a whole different team than the new incoming one. Is that possible?
Yeah, they try to bring their best people, so you'll see like a lot of seniors that work with the same partner and same thing with the manager.
Okay. Yeah, so my question would be if they're saying they're capturing partner effect in that because it's a mandatory partner rotation. So it's the partner who's really in charge, brings their expertise to the new engagement, and that might impair the audit quality. But it might just be, I think, the audit team that the partner brings in. Because we have, I think, in one of my prior papers, we saw that it's really the seniors and the staff that spend much of the time with the client, and then the audit, the partner, might spend, I think, 10%. So out of all the amount of time that the auditor spends with the client, maybe the partner spends 10% of that.
They barely see the time, the client. Partners spend time with senior management and luncheons, free martini dinners, and etc. And you really deal with the manager, correct? With the manager. And I think there is this effect. I never did it, so I don't know, but there is the fact that you take your own team, meaning you work with Andrea in another engagement, you're comfortable with her work, you try to get her to join you the next engagement. But you know, the rotation of staff, junior staff in these firms, is astonishingly large. Okay, people try to get their 2 years experience, and many of them just leave the firm. They don't like life. Right, Andrea?
Well, that's what it was. Like, usually you have some downtime, which means that you're on assigned, and you're at the office just doing e-learnings, which are trainings online. But for some of us, for some reason, the HR, she would say, oh, you have 2 days off, go to this new client for 2 days, and then go back to the regular client. And that was life. And I feel like I didn't learn anything because I was bouncing from one client to another client.
Partly. And then there are months that you are working 80 hours a week. Right? So it's quality of life. And you know, I see in my USC days, which is a long time ago, they were auditing firms, not for profits and things like that, for free. Close to free, just to keep staff occupied. I think that decreased now, but I think at that time there was a lot of that. So So the quality of life is miserable. At that time, there was very manual. So, you know, when you are auditing, you were writing and using the 10 key to add columns, you can imagine. And then the working paper, little markings, characters that you do by hand. And so it was, they still have some of that stuff. And so it's pretty tough life. The managers run several engagements, but you can have small engagements. And so sometimes you don't even see the manager, you just see the CEO. Is that correct, Andrea? Yeah. And I had students that they worked for 2 years in a CPA firm, and they worked in one audit, and not only in one audit, in one purchase to pay. That's all what they did. Because, you know, it was a very large firm, and that's what they did. And so they, you see, they always say that you are in a small audit engagement, you get better experience because you work on the entire audit. Have you ever had small clients?
Yeah, private clients.
And so that's interesting. On the other hand, small firms don't have good business practices as well as the big firms. No ERPs, et cetera, et cetera. And for many years, we are doing the small firms, we're doing still the hand audit, which I think is much less now, but still.
The authors try to use SOX to reshop to minimize the documenting, presumably affects to diminish after familiarization with an accelerated rotation period. So what I'm trying to say is, if they had done this maybe now in 2017, then because the auditors, because now they have mandatory audit partner rotation, so they might have new measures in place that help the new audit partners familiarize themselves with the client, like we mentioned, having the junior partner shadow it, and then so the effects might not be as acute as what we've observed in their studies. And I would be interested in to see how that actually changed if it might have changed at all. I think it also relates to what we were talking about last class. Maybe that's why we would see a need for having databases to log this knowledge, so that in future rotations, the audit partners can reference the database and their teams could reference the database of knowledge that they already have to improve their audit qualities, even though they have this mandatory partner rotation. Also, because we're accounting students, I have to bring, we just learned about this actually with our other professor in our accounting class. So they try to measure persistence and predictability of the earnings, which is only one aspect of earnings quality. But how about, there's usually a trade-off between other effects such as relevancy, timeliness. So maybe by the audit partner, the new audit partner agreeing and okaying these discretionary goals that they saw as meeting or beating these earnings forecasts only, maybe they were trying to trade off on aspects such as it would actually allow them to have more relevancy when they reported a certain way, more timeliness, and then they didn't really try to capture that. They also only use accrual measures based on the Jones model without other accruals models that they can use. And that is all I have for my presentation.
So did you like this paper? Jimmy?
I actually had a question. I was just checking through, and it didn't say if they looked into why the companies changed auditors in the first place, did it?
No, they didn't. Yeah,
And
so
if you look at the descriptive statistics, when they look at Big Four, I believe the Big Four conducts like over 90% of all audits out there. So it says here that it's like 60% of them are audited by the Big Four. So it seems to me, when you look at that and some of the other descriptive statistics, that maybe there was a reason that isn't just, oh, we wanted a cheaper audit, why they swapped audits. And my concern would be, it could just be that they're actually just measuring an improvement in accounting quality that should be occurring anyway, and not as a result of changing audit partners. Because all of the descriptive statistics, when you look at the change in audit partners, trend in a direction that says the business is improving and accounting standards could be improving regardless. But they also don't show the descriptive statistics leading up to the change in audit partner. You can't really see for sure if it's a trend. But that would be my concern, that maybe they just pick a sample of companies that are improving audit or improving accounting standards within the company anyway, and it just so happens that they're changing partner.
I guess it could be your concern is okay, omit some key variables which drive the.
Yeah, like if a company swapped auditors because the other audit partner that they were with, or the other auditing company with, maybe they were going to issue a bad opinion or something like that. So they start improving their accounting standards with the new auditor, and that's all you're really measuring.
I guess it could be because there's always a problem of accounting research. Sometimes you just say, okay, I find one variable and then we can test it, but it could be some other reasons. This didn't try to solve this mostly, but for this paper, maybe okay.
Except in the physical sciences, where there are physical interconnections between things, there's always that type of research problem is where things correlate with their little values.
There's always a problem. It's
Right?
right.
If you have two pulleys tied together, if this moves, and there is no hidden effect. But the moment you start doing economics or etc., there is always this potential. And particularly this paper, because it was a very kind of odd selection that they had to do, which was I thought was a good idea. Right? But I think your point is well taken. Large companies will change auditors less than smaller companies. I don't remember any research directly, but that has been always my belief. Okay, and companies in distress will change auditors more often than the companies not in distress. And I think that's definitely a finding in many research. And I think Yoon and Tiffany, etc., this class 2 years ago did a paper like that they are trying to publish at this moment. I think in the Audit Journal we reviewed at this moment. But your point is well taken. This is actually well taken. If they only chose companies that change auditor, is a high likelihood that that sample is a more distressed sample than the other sample, than let's say randomly pulled sample, and is also it's a more distressed sample.
They could control for it though. If they had only selected people that changed auditors and stated as a reason, economic reasons, i.e. like they
You know, the reason thing, we talked last class, you remember, very often companies are not going to say the reason, firms are not firms, like CPA firms, are not going to say the reason why the auditor change happened. They're going to say economic disagreement. Because the last thing they want to do is say something about the client, and then what happens? They get sued. And the other thing is other clients will see that they spill the beans and they don't want it. Because, although choice of auditors based on their leniency is a factor, I don't think it's a factor with everyone. I think in most people the factor is auditor shopping. I think it's less a factor than the pricing. But that's only my experience. I see Marina in action. She had like 7 jobs in these years, and she was most times CFO or chief return audit. So I kind of saw her changing auditors. And I've seen other firms changing auditors. So I think it's more economics than anything else. But I definitely think the way they chose, and then you notice that it's very interesting because a lot of the hypothesis and the analysis is kind of thought through based on the selection of the sample. It's not like, what would I like to examine in rotation because they can't. I like this paper because I think it's, I like when people have a kind of narrow idea that can do something differently. I never seen something done exactly this way. And they carry it through. So I like this thing. You know, you guys know better about accruals than I do. But that was my kind of reaction to this. I want to see that paper comparing sketching out through on that. I just know several cases of fraud where the fraud was perpetrated by large accruals. WorldCom, the big example. Thank you very much. I think we have time for talking about one more paper, correct? Are you guys sleepy? No? Typically one partner and a secondary partner. But there are circumstances. For example, you're auditing IBM. 50% of the income of IBM comes outside the United States, more than that now. Okay? It's difficult for a partner to manage that. The reason why, you know, you said another thing, Selena, that just occurred to me, is I think the example from Taiwan, same thing as the US, 90% of the firms are audited by the Big Four. But that's not the number of firms, really. It's 90% of the dollars or whatever. Smaller firms tend to be audited by smaller firms. Now, what did you ask? Remind me. I think there is a whole variation around that. I actually never seen a paper on that, but I think there is a variation. Andrea, you might know better than me.
I think usually two, but like you said, if it's a multi-location engagement in different countries, then there's going to be a lot more partners involved.
So there are two partners, are they in the same level, or do they have like junior, senior?
Usually it's like a senior partner that oversees what the junior does.
Okay, so like what's your promotion, the average promotion like from the junior to the senior partner?
I'm not sure about that.
So like in the junior partner can be promoted to the senior partner. The average is less than 5 years.
I was just thinking about that. Is I think typically is the junior partner comes in the third year of the senior partner. Isn't that what it is?
I think it would be either 3 or 5.
Huh?
3 or 5 years that they rotate.
Yeah, they will take it 5, but the new partner that comes in, it comes in the third year.
Oh, they start to shadow. Yeah,
Yeah.
it would take at least a year before their rotation.
At least 1 year before. Actually, that's a question we should ask to McCullough or etc. I never looked into that. I actually would be interested also in finding how long managers take managing an engagement.
Not that long. But usually longer than the senior and other staff.
Yeah, actually, all those things would be interesting to look at, like how long juniors take engagement, seniors take engagement. And I don't think there is a lot of research on that because the data is quite. You know, you're talking about this. I had an idea, okay, which I called it the transparent audit. And what would happen if every piece of data generated in an audit would be made public?
There are some. How about the Coca-Cola purchasing the histories? Those kind of might be part of the working papers, of their secret of the recipes.
Or you could burglarize the office of a CPA firm and steal all their work papers. Or even better, we have some experts here. We can hack into the systems of the CPA firm. Don't look at me. I'm not thinking of you, but I'm thinking more of Jamie and Ben or Stanley. Freddy is looking at his working papers of one of the firms that gave it letters, asked permission to the client, and we are looking at it. Maybe he can. No, I'm kidding a little bit, but not kidding totally, because open data. What is open data now in government? Open data is basically they put a lot of the transactional data. What is it that Ohio has the open checkbook? And basically every payment they made is fully disclosed. So maybe some more localities would like an open audit. I don't think I'm going to write about this. I will make myself very unpopular with auditors. So I don't think I'm going to write about this. Would not be very good for radar or something. But it's an interesting idea, isn't it? Don't you guys like when you read a paper and get an idea of something different? Jamie is writing it down. Next thing he's arguing for an open. I kind of like the idea. So imagine there are open audits, and then in our audit class, we can make the students go to the open audit to learn what auditors do. It's pretty cool idea. They can convince the university. No way. But the university actually has been very good in the last 2 months. You know what they did? They gave us purchase to pay, access to pay on the new ERP. And we are doing a course for them in 2 weeks. And Hussein is kind of running that effort in the company. I don't know who's going to be teaching on that, it will be, but we'll be